One handle, two platforms. That handle is the only fingerprint they can't forge. If anyone DMs you for money, wallets, VIP access, or signals, it's a scam. I sell nothing, ever. Now type ratio in the comments if you're locked in, because gold is ripping around $500 to $400 while silver is still sitting around $95. And the internet is screaming one sentence like it's a law of physics: $300 silver is mathematically locked. Stop. This matters, because that sentence is half true in a way that can make you money and half false in a way that can wreck you. Quick transparency. The specific Yahoo Finance article link you sent is currently rate limited, blocked from my side, so I can't quote it directly. The same market snapshot and catalyst framing, gold around $5,400, silver around $95, risk off from Middle East violence, oil jumping, is confirmed by multiple mainstream outlets today. Now listen, gold doesn't open near $5,400 because someone drew a line on a chart. Gold opens near $5,400 when the world is repricing risk, when investors stop asking what's the return and start asking what survives. And the fact that big investors are favoring gold over even government bonds right now tells you this isn't normal. The Financial Times describes investors turning to gold and the dollar, not bonds, because inflation fears, driven by energy shock risk, make bonds less protective in this regime. So the setup is real. Gold is screaming trust problem. Now, why is silver only 95? That word only is the trap, because only implies silver is cheap. Silver at 95 is not cheap. It's already a high volatility, high stress regime. It just looks small next to gold near $5,400. And whenever silver looks small, the crowd reaches for the oldest relative value weapon in precious metals, the gold to silver ratio. Here's the math everyone keeps quoting. No hype, just arithmetic. Gold price, silver price, gold to silver ratio. If gold is $5,400 and silver is $95, the ratio is $5,400, 95, 56.8. Call it 57.1, meaning 1 ounce of gold is worth about 57 ounces of silver right now. Now comes the viral leap. If the ratio collapses, silver explodes. Therefore, $300 is locked. But what they're really saying is this: to get $300 silver while gold stays at $5,400, the ratio must compress to $5,400, $300, 18. So the $300 locked claim is secretly a second claim. The ratio will collapse from 57 down to 18. That is the real bet, not the price, the regime, and regimes are not guaranteed. Regimes are earned through behavior. Stop. Burn this into your brain. A ratio is not a prophecy. A ratio is a thermometer. It doesn't tell you where the market must go. It tells you what the market is preferring right now, gold versus silver, and whether that preference is shifting. So here's the honest version of the whole video. At gold around $5,400, triple-digit silver is mathematically plausible with modest ratio compression, but $300 silver is not confirmed unless we enter an extreme silver-led regime where the ratio compresses toward Order's 18. That's not a math certainty. That's a behavior shift. Now I'm going to map the exact behavior shift required, and I'm going to do it the way you can actually use, without worshiping a target. There are only 3 forces that compress the gold to silver ratio aggressively. 3. 1. Silver becomes monetary again in the public mind. 2. Silver becomes tight in delivery terms, physical stress that paper can't ignore. 3. The macro stress persists long enough that silver flips from following gold to leading gold. Let's hit them fast. First, silver becomes monetary again. Gold is institutional, central banks, large allocators, default crisis hedge. Silver is the public's metal. It feels accessible. It feels like cheap gold. It attracts the crowd when fear spreads beyond institutions. If the crowd shifts from watching to acting, if silver becomes the I can still buy it hedge, silver can outperform gold simply because the market is thinner and reflexive. That's ratio compression. Second, silver becomes tight in delivery terms. This is the paper versus physical fault line. When everything is calm, paper leads and physical follows. When the system is stressed, physical starts leading and paper has to chase. You recognize that world by behavior. When paper price gets slammed, does physical soften instantly, or does physical stay stubborn? Premiums hold, availability tightens, and buyers refuse to wait? That stubbornness is what people translate into default talk. Not necessarily a literal default, more like delivery trust and settlement friction becoming the story. And in a regime where investors are already choosing gold over bonds because inflation fears complicate the normal playbook, delivery trust becomes more important. Third, macro stress persists. Gold can spike on a headline. Silver needs persistence to truly lead. When a crisis morphs from headline fear into energy and inflation consequence, silver gets an extra engine, because silver is both a hard asset and an industrial input. Today's broader coverage ties the safe haven bid to escalating Middle East conflict and the risk that energy disruption keeps inflation fears elevated. That's the environment where silver can start outrunning gold. Now stop. Here's the open loop that decides whether the $300 crowd becomes legends or becomes exit liquidity. Does this crisis stay hot long enough for silver to shift from sympathy bid to lead metal? Because if it does, the ratio starts compressing steadily. If it doesn't, gold holds and silver chops. And most people lose money not because they were wrong about direction, but because they were wrong about regime timing. Now let's make this concrete with a ratio menu, so your brain can see the difference between plausible and extreme. At gold, $5,400. Ratio 57, silver 95, today's neighborhood. Ratio 50, silver 108 on. Ratio 40, silver $135. Ratio 30, silver $180. Ratio 25, silver $216. Ratio 20, silver $270. Ratio 18, silver $300. So yes, triple digits do not require a miracle. But $300 requires a major regime shift. And the regime shift reveals itself before the headline number prints. How? By silver's behavior relative to gold. This is the simplest daily ritual in precious metals. If gold is up 3% and silver is up 2%, silver is underperforming. Ratio isn't compressing. If gold is up 3% and silver is up 6%, silver is leading. Ratio is compressing. If markets wobble and gold holds while silver collapses, ratio widens. Gold only fear. If markets wobble and silver holds up surprisingly well, ratio compresses, silver's strength, regime. That's how you stop being hypnotized by targets and start reading the tape. Now, why is this title so viral right now? Because the same outlets describing gold near $5,400 are also describing the reason: escalating Middle East conflict, oil shock risk, and investors rushing into safe havens. In that environment, people look for the next move. Gold already moved, so the crowd hunts the catch-up trade, and silver is the catch-up trade that can move the fastest because it's thinner and more emotional. That's why only 95 feels like still early, but feeling early is not the same as being early. Silver can make you feel early, right before it dumps and then rips again. That's why you need a watch list, not a fantasy. Now, the resistance case, because credibility matters. There are crisis phases where gold outperforms silver. Barron's even notes that silver can be volatile intraday, sometimes giving back gains even while gold surges because silver has its own positioning and sensitivity. Silver is also industrial. If the market shifts from inflation fear to growth fear, silver can lag. And silver is more vulnerable to forced selling. In high volatility moments, leveraged players get flushed. So no, silver is not guaranteed to catch up immediately just because gold is high. The ratio can stay elevated longer than anyone expects. But here's what makes today different and why the ratio narrative is catching fire. The Financial Times describes a market where inflation fears and energy shock risk are making investors favor gold over bonds, meaning the market's normal defensive structure is being questioned. That's a regime where hard assets can stay bid longer than people expect. And if it persists, silver can eventually get pulled into leadership. So again, not guaranteed, but structurally plausible. Now here's your 48-hour watch list. Binary, addictive, screenshot worthy. 1. Gold hold test. If gold holds firm near these elevated levels across the next sessions, fear is persistent, not just a headline spike. If gold snaps back hard, it was a fast risk premium repricing, not a sustained regime. 2. Silver leadership test. If silver starts outperforming gold on up days and refuses to underperform on down days, you're entering a silver-led phase. If silver fades while gold holds, it's gold-only fear. Ratio compression won't happen the way $300 narratives require. 3. Energy and inflation stress stays active. If energy shock risk persists, inflation fears persist, and investors stay biased toward hard assets, exactly the dynamic FT highlights. If energy risk cools fast, silver's inflation tailwind weakens. 4. The slam test. When silver gets hit, does it snap back fast? Fast rebounds mean buyers are waiting. Tight market behavior. Slow bleeding means the bid is fragile. That's it. Not 1,000 indicators. 4 tests. Now, the final open loop. If the world is repricing risk hard enough to put gold near $5,400, confirmed across major coverage, then silver's next move isn't decided by your target. It's decided by whether silver begins to lead gold. Because if silver begins to lead gold, triple digits stop being a meme. And if silver does not lead gold, $300 talk stays content. This isn't financial advice. This is financial warfare education. 3 takeaways and we're out. Gold near $5,400 is being driven by a safe haven rush amid Middle East escalation and inflation dark energy shock fears. $300 silver mathematically implies a gold to silver ratio around 18 at gold, $5,400, meaning you need an extreme silver-lead regime, not just a high gold print. The only way to know if that regime is starting is to watch relative behavior, silver leadership, ratio direction, and how silver reacts on dips. Drop ratio if you want me to keep mapping the regime signals as the next session's print.